In terms of what we saw last week, two big events. You had the Fed on Wednesday and then jobs report on Friday. Whole lot of noise, but ultimately, market not really moving too much when you look at the overall week there. What do you make of how this market has set up so far this year? Because it really seems to me like it's been unable to get any meaningful traction in either direction.
It really has. There's just a lot of strong offsetting currents that are keeping the market kind of where it is. Now, it definitely is, as many have observed, a split market, right? It's not like the majority of stocks are at the top end of their range and up 8 or 9% the way the S&P 500 is. It definitely is skewed toward a handful of very large stocks. But to your point, haven't had a lot of downside momentum either. I think part of that is just the real economy is strong enough. Nominal GDP growth, sales growth at companies is just a little bit too strong in the near term to get people so excited about betting on an imminent recession. We've been kind of preparing, I think, psychologically for something of an economic downturn for well over a year, and it hasn't quite arrived on time. To me, what Jay Powell said after the Fed decision last week is kind of telling. So he described the job market as still very tight, but he also described monetary policy at this point as tight. In other words, they've done enough on the rate side. So I think the market is of the view that the Fed is likely in a pause in terms of rate hikes. There's probably a high bar for cutting rates unless there's some kind of financial accident. And so we're in this zone of growth is still okay. The Fed has tightened, but maybe is done. And what the banking crisis has largely done since March is probably brought forward the date at which the Fed was saying we're done raising rates. And now the question is, at what cost have we gotten a slightly more dovish Fed?
Is some of this just because of how the last few years have gone for us from a psychological perspective, in that we go through March of 2020 and everything happens so quickly then that are we just lulled into a sense of, hey, that's how quickly the economy moves? Whereas, I go back to the housing bubble credit cycle. The Fed stopped hiking in July of 2006, and things didn't really blow up until 2.5 years later. Is it just that we think things move so much faster now that we're waiting for this recession imminently?
I do think there is generally a sense out there, even in other cycles, that once you get unemployment low and once it feels like we're later in the cycle, you do start to over-anticipate a recession. But I definitely agree that we have this incredibly compressed cyclical forces that actually happen starting with the pandemic. And we got back into boom-bust mode as opposed to what had been previously that great moderation, which was kind of slow growth. We can't get inflation moving. Job growth is steady but not impressive. Now you have been had a lot of whipsaws, not just with the COVID crash where you forcibly locked down the economy, but then the volume and speed of the stimulus and where we got to in terms of just the absolute level of activity, whether it was buying of homes, whether it was wage growth, everything seemed to get onto hyperspeed. And what's been fascinating is the market interplay with the economy has not really been to script. What I mean by that is a year ago, before the Fed started raising rates, a year plus ago, everyone said, yeah, sure, the Fed's got to start to tighten here. But, the stock market tends to do well in the first 6 to 12 months after a tightening cycle starts. Well, this time, the market backed off hard in the 2 months before the Fed started hiking, and then it continued lower, and you got a peak-to-trough 27% drop in, 10 months. So it seems like we are on a bit of a hyperspeed mode because we do have this sort of spring-loaded action in the economy itself and in policy.
Mike, this is Mike Armstrong. Been a busy few weeks in terms of earnings, other than apparently every CEO out there being on the cusp of the next breakthrough on artificial intelligence. Any big takeaways from the earnings season thus far?
I would say one of them is that companies have shown that they were able to move relatively quickly on the cost side to preserve margins a little but better than feared. I don't think it's necessarily the case that they're going to go back to peak profit margins, but so far they've kind of managed to kind of hold the line a little bit. And what's interesting is that the guidance that the companies are giving is pretty much reaffirming the outlooks that they had coming into the year. Now, you could kind of look at that one of two ways. One is that's positive. They have confidence they're going to meet their plan. The other one is almost all companies have exceeded first quarter earnings estimates, So by them saying the rest of the year is going to be according to plan, implicitly it's giving them some room for conservatism there because they're not marking up the whole year by what they beat in the first quarter. But I think in general, it's been a better than feared is still the mode. We have the 12-month forward consensus earnings forecast have actually curled higher over the last few weeks, so it's hard to know if that's sustainable. But if we have a flattening out of earnings as opposed to a real severe decline from here, then I guess you can kind of make the case that most of the pain has been felt already in stock.
This gets at one of my big questions here, Mike, and that is, so we have, again, forward earnings growth being projected here. I think by Q4, we're expected to be seeing earnings growing, 8-9% plus year over year. And yet at the same time, we see projections for GDP heading negative by Q4 of this year. How do we reconcile those two things at this point in time?
I don't think you can reconcile them in a very precise way, except to say that earnings will tend to lead GDP, right? So you basically had from the middle of last year till now, the 2023 consensus for earnings went down by 15%.
Yep.
So even though it's going to be flat year over year on the whole, or maybe it's going to be up in the back half, you're going to have easier comparisons, plus the fact that you already somewhat marked them down from what we thought it was going to be in the middle of last year. But no, if you have outright declines in GDP in the latter part of this year, it's going to be tough to make the numbers. The other part, though, is, and this is, I think, is what has thrown people off, is presumably if inflation is still, 4% or more, or maybe give or take, nominal GDP growth is still going to be solidly positive.
Right.
Companies measure their sales in nominal GDP. And so that's something we weren't used to having to adjust for in the 2010s.
Very good. Mike, appreciate you joining us today. Thanks so much for the time.
Glad to do it. Thank you.
That is Michael Santoli from CNBC talking about current market conditions and what we're seeing in, again, kind of a disjointed market still at this point.